Greetings, sir. This is Group 2. Today, we are presenting the ERP programming process in Odoo. Our group consists of 4 members, which is Zhang Xing, Emily Chong, Si Wei Hang, and Ho Guan Yu. The company that our group have chosen is Yonex. It is a sports equipment manufacturer, and the products that we have chosen is Xtrox 01 Ability, Xtrox Lite 371, Active Backpack, Pro Racket Bag, and Tennis Racket V-Core 7th generation. And the customer that we have chosen is Smash Rocketo Sendirian Berhad. We will start with sales and distribution. Quotation. We insist that Smash has already inquiry for the required products, so the Yonex sales teams creates the quotation for them, which includes the product prices, quantities, taxes, and the payment terms. So they also have the built-in data to ensure the accuracy, and it is easily converted to sales order after they have accepted it. Next is sales order. It is a formal agreement after confirmation of quotation is made by the customer. So it confirms the items, quantities, terms, and pricing. Odoo automatically checks the product stock after the confirmation, and it notifies production if manufacturing is needed when stock is insufficient. For delivery scheduling, it checks stock levels automatically and generates delivery note when items are in stock. It also creates back order and partial delivery when stock is insufficient. For this scenario, Odoo notices that there is insufficient stock for the order, so it creates a back order and 2 deliveries, with the first delivery to deliver the products in stock and the second delivery to deliver the remaining products to the customer. Next, for invoice. Invoices are generated after delivery has completed. It includes the product details, the actual pricing, and the taxes. So it is connected directly to the accounting department so that they can ensure the financial accuracy. There are 2 types of invoices. Regular invoice, when the customer make a full payment for the order, and down payment invoice, when the customer pays a percentage amount of total price or a fixed amount first, then the remaining amount later. Next is payment. There are 3 payment status: paid, partial, or outstanding. The payment received confirms that the goods or services are received by the customer, and it ensures the matching of goods and the final transaction. It also helps to improve the accounts receivable management and cash flow tracking for the company. Next is credit note. It is used when there is damaged goods, incorrect delivery, or pricing error after the customer have made their payment. So it is created directly from the invoice for accountability, and it adjusts the customer's balances automatically. Lastly is the customer relationship management. It stores the customer information and it tracks the progress from the contact from the customer to the finishing of the sales, and to ensure that no sales opportunity are missed. There are 4 pipeline stages, which is new, when a new lead is created, qualified when the lead is verified, proposition when pricing and proposal is offered to the customer, won and when the customer confirms to purchase from the company. So it ensures that the potential customer progress through these stages until the deal is closed.
For the second chapter is inventory and purchase, and there are included 7 processes, which are the stock management, vendor evaluation, request for quotation, purchase order, vendor shipment, invoice receipt, and the payment. For the stock management, we need to maintain the correct stock level to meet the customer demand without a shortage and prevent overstocking to reduce the holding cost and free up cash flow. And the last one is optimizing the inventory can improve the efficiency and the overall profitability. And you can see our table. The steel tub currently is 0 unit on hand, so that indicate that we do not have the enough material at the production process. For the vendor evaluation, we need to evaluate the supplier reliability, capability, and performance. Inside the performance also have quality, delivery, cost, and support. So we use the result to decide whether to retain or assist for improvement or replace the supplier. And regular review can ensure the smooth supply flow, reduce the risks, and support the business growth. So we already doing the comparison for the multiple supplier, which is Victor, Leaning, and S Carbon. So you can see the total score. Victor scored the higher 8.4, and the S Carbon scored the lowest score 7.7. So finally, we will choose the Victor as our supplier. For the request for quotation is RFQ is an invitation sent to the supplier to collect the pricing and the terms for the multiple supplier to compare the offer and choose the most cost effective and the reliable option. So a purchase request is clearly lists the required item like aluminum shaft, carbon fiber, and so on to avoid the estimation or error. So sending the request to several suppliers can improve the selection accuracy and help to secure the better pricings and supplier reliability. So I already mentioned at the before, the steel tub currently only 0 unit at our stock, so we need to send the steel tub to the supplier. Okay, we send the RFQ to multiple supplier, which is the Victor, Leaning at and the Ace Carbon. So we request for the steel tub and the expected date is November 18 and the quantity is 100. And you can see the RFQ, we already success to send the RFQ to the vendor Ace Carbon. So here is the attachment, a request for the quotation from your next, so which is our company. So the vendor can start to giving respond us the price and the delivery date to let us to doing the evaluation. For the purchase order is a purchase order is an officially document confirming what the buyer want to purchase, including the price, quantity, purpose, and the agreed terms. So as you can see our receipt, we already choose the Victor as our supplier. So it turned the approval quotation RFQ into an actual commitment to buy from the selected supplier. They act as a legally binding agreement that clearly outlines the responsibility between the buyer and the vendor. As you can see our purchase order receipt, we already buy the steel tub quantity 100 unit price with the 30 ringgit, and the tax is 10%, so the amount is 3,000. For the vendor shipment is we already create the purchase order and send to them, so the Victor supplier will receive. Then they start to doing the shipment. So here is the two Victor supplier shipment and also the delivery document they are confirmed. So for this part is invoice receipt. So we already create a bill for the vendor. So the vendor bill. So the description is steel tub, quantity 100, units price is 30 ringgit, and the amount is 30,000 we need to pay to the vendor.
Now I will introduce the manufacturing process. Manufacturing process has 9 parts in total. The first part is production planning. Production planning reflects the increasing need for integrated software solutions in order to optimize the manufacturing process. Any production-based company is dependent on these key processes: demand forecasting, production scheduling, material management, and the coordination of activity on the shop floor. Before entering the manufacturing process, we need to create BOM at first. BOM refers to the bill of materials. It is the root of all data. We create accurate multi-layered BOM for these 5 products. For example, you can see the first screenshot. The first screenshot shows the product need steel tube, carbon fiber frame, frame grip, and other ultimate materials. After create BOM, we come to the work centers. A work center refers to an organizational entity that actually carry out the value-add manufacturing activities. It specifies the production resources, process capabilities, and the cost accounting standards. The screenshot shows all work centers that have been defined in this project. This covers all steps from raw material processing through the packaging of finished these 5 products. After work center, we in the routine. Routine refers to the sequence of operations that are required to transform raw materials into a finished product. It defines what needs to be done, where it's done, refer to the work centers, when it's done, and how it's done. This screenshot shows the complete process rules we have defined for 5 product categories, covering badminton rackets, tennis rackets, and bags. All routines are based on the BOM and work center. They ensure traceability of the production process. And then we come to capacity. Capacity refers to the exact number of identical units or processes that a work center can process. And simply, it refers to how many units this work center can produce at a time. This determines the actual output capacity of the work center. The screenshot shows capacity for quality check work center. You can see the different products have different capacities. This part is forecasting. Forecasting refers to a method that uses historical data analysis, statistical models, and the expert judgment to forecast the future demands. It allows companies to forecast the market demand, manage inventory levels, and device production schedules. The screenshot is forecasting for Astro One Ability Badminton Racket. And then we come to the MPS. MPS refers to the master production scheduling. It involves the determination of what to produce, how much to produce, and when to do so. MPS is a fully specified plan coordinate with manufacturing activities according to actual and forecasted demand to ensure efficient resource usage and stable production flow. So for this screenshot, you can see the our MPS for this 5 products. This part is for the MRP. MRP refers to the material requirement planning. It calculates the type and the quantity of materials actually needed for production. It achieves this by calculating net demand, taking into account current inventory. Please note the input for MRP is provided by BOM, which then delivers purchasing plans and the production orders. This screenshot is for the Astros One Ability Badminton Racket MRP. Finally, we in the production scheduling. Production scheduling is the final step in the ERP manufacturing module. The system automatically breaks down the manufacturing orders generated by MPS and MRP into individual process according to the routine, and then assign tasks based on the real-time load of each work center. During this process, planners can see the Gantt chart and drag and drop adjustment. This screenshot shows the complete scheduling and the execution result of the manufacturing order. You can see all work centers are complete.
This balance sheet shows your next financial position. The company holds total assets of about 92,000 ringgit, with the largest portion of coming from receivable and around 40,000 ringgit in cash. On the liability side, your next only carries around 11,000 ringgit in short-term payables, which is relatively low. This means the company has minimal financial risk and strong short-term stability. Equity stands at about 80,000 ringgit, showing that the business is mainly financed through internal ownership rather than debt. Overall, the balance sheet reflects a solid financial foundation in high assets, low liability, and strong equity. This indicating that Yonex is in a good position to continue operation and support growth. Here is the income statement of Yonex. The company generated strong sales revenue of around 100,000 ringgit, which directly contributed to a high gross profit because there were no recorded cost of goods. So operating expenses were kept relatively low, mainly from general expenses. After deducting these costs, Yonex achieved an operating income of about 122,000 ringgit. This means the company converted most of its revenue into profit, indicating efficient cost management and healthy financial performance. Overall, the income statement shows that Yonex is operating profitably with a solid margin, which supports sustainable growth and going forward. This is cash flow statement. There were no cash movement from investing or financing activities, indicating no asset purchases or loan prepayments during the period. The company finished the month with a closing cash balance of 40,000 ringgit, which reflects strong short-term liquidity. In my opinion, Yonex demonstrates solid cash management. Although relying solely on operating inflows may limit long-term growth without additional investment. The general ledger provides a complete summary of all financial transactions recorded during the month. The bank account reflects the company cash movement, while accounts receivable shows outstanding customer payments still to be collected. Account payables capture the company's obligation to suppliers. The SST control account record tax entries, and the trade income account shows all recognized sales, revenue, operating and sundry expenses are recorded under their respective expenses account. Overall, the ledger is fully balanced, with total debit matching total credit, indicating that all accounting entries have been properly recorded and the financial system is functioning accurately.
For the challenge, we have four parts: CVP analysis, dynamic pricing rules, scenario-based simulation, and automated profit alert.
For this part is CBP analysis. So first we need to calculate the contribution margin per unit. So the formula is contribution margin CM is equal to the selling price minus the variable cost. So you can see the table and doing the minus. So the CM ratio is contribution margin divided by the selling price. Then you can get the CM ratio. So for the break-even point unit, the formula is break-even point equal to total fixed cost divided by the contribution margin per unit. So the total fixed cost is 20,000. So at the below table, we already show the calculation. For the last one is we need to calculate the total contribution and the profit. So the formula for the total contribution is the contribution margin per unit multiple with the units sold. So at the table show at the below, so have the contribution margin unit per sold, and we already calculate the total contribution for each product. So we also need to calculate the net profit. So it's equal to total contribution minus the fixed cost. And also we also need to calculate the total revenue is equal to sum of the selling price multiple with the units sold. The last one is the profit margin. So the profit margin is the net profit divided by the total revenue and multiple with the 100, so which is a 37.1%.
For the dynamic pricing rules, it supports cost-based pricing, inventory-based pricing, and automated selling price calculation to ensure faster and accurate pricing decisions for each product. For cost-based pricing, it calculates and updates the selling price of the product automatically based on the bill of material costs, labor costs, and overheads. It prevents selling the products below production costs and maintains desired profit margin of the company. Next, for inventory-based pricing, it calculates the price based on the quantity ordered to encourage balanced inventory flow. So for quantity above 100, the unit price for the product is a discounted price, and for the quantity below 100, the unit price for the product will be the normal price.
For scenario-based simulation, I will explain an example. Raw material cost increased by 20%. According to scenario simulation, when the raw material cost of our product increased by 20%, the total production cost will rise. Because the selling price does not change, the compressed profit margin directly influences the declining margin of each product. You can see the margin loss result. We lost about 6,539.4.
Another challenges mentioned, which is using profit alerts to help the business detect early signs of financial risk. In any manufacturing company, profitability can be affected by several operational factors such as overtime labor costs, high inventory storage costs, or sudden increase in raw material price. Monitoring these KPIs is essential because they directly impact profit margins. The goal of profit alerts is to notify management as soon as any cost exceeds its acceptable limit. This allows the company to take quick action, maintain healthy margins, and support profit-driven decision-making across the organization. Here are the four key profit-related KPIs that companies should monitor to protect profitability. The first KPI is overtime labor cost. When overtime increase, the direct labor cost per unit also increase. This reduces the company overall profit margin. In our case, if monthly overtime exceed 22,000 ringgit, it becomes a warning sign because production becomes more expensive. This KPI helps managers adjust scheduling and reduce unnecessary overtime. The second KPI is inventory carrying cost. Keeping too much inventory leads to higher warehouse and storage expenses. For example, if your next health excess stock and the inventory holding cost goes above 1,000 ringgit per month, profit begins to decrease. Monitoring this KPI helps prevent overstocking and encourage better inventory turnover. The third KPI is raw material price increase. Your next relies on materials such as carbon fiber, frames, steel grip, and grip materials. When the price of this raw material increased by 10 to 15%, the company net profit drops unless the selling price is adjusted. Tracking this KPI helps a purchasing manager respond quickly by renegotiating or adjusting pricing. The final KPI is falling profit margin. If the gross profit margin drops below 20%, the company enters a financial risk zone. This means production costs may be rising or selling price may be too slow. When the KPI falls, the company must take immediate action such as increasing price or reducing operational costs. Overall, these four KPIs are crucial because they directly affect profitability, and monitoring them ensures that the company can react quickly to the maintain healthy financial performance.
Our presentation is over. Thank you.